The market slipping into the red after a 4-week rally yesterday. It fell also on Friday and Monday. It seems that it hasn't managed to sustain this positive momentum. The good news that foreign investors are still in the market. We've got them on the buy side, still buying up Kenyan equities. What is your reading of sentiment on the local front?
I think for the local fund managers, they're largely getting out of equities and opting to get into the money market. With the T-bills at the high levels that they are, it actually makes sense for them to invest in that way and probably make a good return over the next 3 months or so. I think largely local funds are out of the market, but we've been seeing a lot of net buying in from foreign funds who've actually been supporting volumes over the short term. And I think the focus has actually been on the likes of Equity Bank and Safaricom at the current levels.
Just looking at some of the headwinds that the economy is facing, we've got fuel prices which have increased. Super petrol up 3 shillings 63, diesel up 3 shillings 36, and kerosene up by almost 5 shillings. What implications do you see this having for inflation going forward?
Definitely a negative impact, because the price range has been 3% to 5% month-on-month hike, which means the impact on inflation in as far as transport costs is concerned will definitely be a major concern. But I think what will be able to mitigate this negative impact would be the declining cost of food, especially with the current rains that are coming on board, and the fact that food supply will definitely increase over the next 3 to 6 months. That should actually be able to offset the negative impact from increase in transport costs.
How's the increase in fuel prices likely to affect energy players like KenGen and KPLC?
For this too, there'll definitely be a surge in terms of cost of electricity. There's been increased dependence on thermal electricity, which is run on diesel. And given the rise in diesel, there'll definitely be an increase in electricity prices, which will be passed on to the end consumer. But I think looking at the two, for KPLC, they're actually able to pass on the cost to the consumer. But for KenGen, they have to incur that cost as they generate this thermal power. And I'd be looking at the two, and the KPLC would be a better defensive play as opposed to KenGen, which is actually involved in the generation of this kind of electricity.
From a longer term perspective though, if you look at KenGen's market share, it has increased to around 70%. It's clawed back market share from independent power producers. It's also got 2.5 megawatts from its Uburu plant meant to come online at the end of the month. Looking forward in the next 3 years, it's adding around 355 megawatts of energy. So it's well positioned in order to maintain its somewhat monopoly in the market.
Yes, it is. But I think if you look at a generator and you look at a distributor, you want to be invested in the distributor, because the distributor is able to pass on any additional cost to the consumer. And in essence, their margins are already preset before you actually get into any financial year. As for the generator, you actually have to incur the costs of these new projects, which are highly capital intensive, and your margins are not predetermined or set in a particular manner as it will be for a distributor company. And for the two, the defensive play would be much more on KPLC as opposed to KenGen.
Looking at the banking sector, falling some 1.5% yesterday. NIC, one of the biggest losers. Results expected soon from then. They have introduced new products in order to target the rich. They're also expected to do well in the asset finance side of the business. I know it's not a bank that's particularly in your coverage, but what would be your broad expectations for NIC?
NIC, like any other mid-tier bank, will definitely struggle in terms of margins. Their cost of funding will increase because the primary source of funding is wholesale funds. And some of these corporates have been demanding as high as 22-23% on any deposits that they put in with banks. So I think for NIC, what we'll be looking out for is just to see how far the margins have actually been compressed over the last 3 months when they report Q3 next week, and also the liquidity levels, because largely the mid-tier banks have actually been coupling with low liquidity levels. So that would be of interest to see once they announce their financials. Staying
in the banking sector, two of the banks that you do cover, Equity and KCB, are looking forward to how this high interest rate regime is going to affect these two banks. You had Equity achieving a 54% year-on-year loan growth in Q3, KCB loan growth coming in at around 40%, really strong there in light of the fact that economic conditions were starting to deteriorate. What type of credit growth are you anticipating going forward?
Next year is going to be a challenging year, not only for these banks, but for the industry as a whole. I think loan growth will definitely have to come to below 20% year on year for the entire industry. The key winners will be those banks that are able to focus on transactional income, able to focus on agency banking, which will be a way of mobilizing cheap deposits and executing basic bank transactions outside of your brick and mortar kind of branches. I think credit growth will slow down, which means margins will be much lower next year, and profitability from your core banking operations will be much lower, and the focus will be trying to maintain costs as well as enhancing transactional income from your existing operations. And the winners of this will be those that have high agency banking numbers and also high branch rollouts.
As you say, and those are KCB and Equity. Equity got 2,000 agents, KCB around 1,300. So this agency model will work in their favor, and the likes of BBK and those which target corporate clients perhaps won't be as resilient.
Yes, that's what I'm saying.
Yeah. Let's just look at those share prices. Equity, it's given up a quarter of its value for 2011, sitting at 19 shillings 95 cents. It's down some 10 shillings from its year high. Value entry point at this point?
Sorry, come again?
Equity at 19 shillings 95, is that offering value? Would you be getting in at this level, or do you anticipate some further selling pressure given the pressure that the banking sector as a whole has been under?
I think for us, we've actually put both stocks under review and have not revised our target prices as yet. But at the current levels, the price to book on Equity and KCB is looking very attractive, and we've been seeing a bit of buying on Equity at the current levels.